Welcome back, dear official investment gurus. We are going to finish chapter 4 on valuation techniques by looking at one of the most respected and trusted sources of data and analysis on stocks, the value line. Slide 37. Traditionally, it was often the only source that many investors used for data and analysis, of course, along with the company's and materials, the annual and the quarterly reports. It's not cheap. It's $50 a month, but you can obtain it for free at various libraries. We had it at Southwestern. We had the cheapy version. Then the pandemic hit, and so we canceled it. And now we're getting it back, supposedly, I'm not sure when, but online. You don't even have to go to the library. Supposedly, it's going to be only for finance and students enrolled in finance classes and accounting classes. But I'm not involved. I'm just getting the emails and scratching my head and wondering when it's actually going to happen. But in the meantime, there's another library, Newport Beach Library, which will allow you to look at the value line for free, but only for 6 months. But then you have to go up there and get a membership card. But they allow you to get a temporary membership card. So Newport Beach, it's a couple hours away. And they will give you for free the value line, all the information on the 30 stocks in the Dow Jones Industrial Average, and then they give you some information on the other stocks. It's called the freemium model. They give you some stuff for free, and then they charge you for other stuff. It's similar to Morningstar, right? If you go to Morningstar, they're going to try to sign you up, and the same thing is true for Value Line. I am a big fan of the value line. I don't do anything without consulting the value line, especially their timeliness and safetiness indicators, and most importantly, their 3 to 5 year price appreciation prediction. I love it. Remember how we said back in chapter 2 on mutual funds, when a mutual fund has about a 3 to 5 year turnover, 20 to 30%, that was a good sign. Well, it was a sign that they were doing kind of what we're doing with the value line. We're looking at about 3 or 4 or 5 years, and that's about as far as we dare to look out. And we continue to do that even after we've purchased a stock, or as we're looking at it, waiting for it to get a little cheaper and maybe fit our desired, required rate of return. One study, which ignored the transaction costs and, of course, the tax consequences, only used their timeliness indicator. It showed how you would have beaten the market handsomely over a 20-year period by just buying and selling stocks as they received and then subsequently lost their number one timeliness designation. Now, that doesn't mean it's going to happen in the future, but it just shows you that they've been around the block a few times. They've been around for decades and have performed well in good times and bad times. So let's go to slide 38. This is a sip from the financial Firehose, folks. I still use, they're getting away from these single sheets. They've had these single sheets for decades. And now it's going all online. But I'm still, I don't know, I guess because I'm just so used to using the single sheets, I'm not as big a fan as using the website. But there are some cool things about the website that because it's interactive and the like. But we're looking for the indicators, the future price projection, the historical data, the cash assets, the receivables, the inventories, the description and analysis of the business, the historical annual rates, the insider institutional buying and selling, the amount of debt, the number of shares outstanding, the company's financial strength and stability, the price growth, and the earnings predictability ratings. Here it is, dear students. This is the top page for Johnson & Johnson as of 10th of February, 2023. They come out for each company every quarter, and they stagger them. So they bunch the companies together into sectors, into industries, and then they come out with a different sector every couple of weeks. And that's why you want to keep going to the library and having a good time. And so look at all this data. We're only going to use a tiny piece of it for our models, but there are other models and you use other pieces of data. We're going to use the dividends for the last 7 years, from 2023 all the way back to 2027. And here they are. And of course, they also tell us about the cash flow and the sales per share and the earnings per share and the capital expenditure and we'll talk about PE more in detail next chapter. The sales, the operating margin, the depreciation. This is a little mini income statement, which we'll discuss the income statements in detail in the next chapter. But here's the prize, in my humble opinion. What do they believe the stock is going to be in 3 to 5 years? They also tell you what the 18-month target price is. They expect in 18 months at between 158 and 234, midpoint being 196. But this is the one we're interested in. Remember, 3 to 5 year time frame. They believe it's going to be between $225 and $275 in price. So we're going to use that midpoint. We're going to use 250. So hang on to that. We're going to use this data in our calculations because we love dividends. We're going to use this data, and then on the next slide at the bottom, they tell you what they think the growth rate for sales, cash flow, earnings, book value. Well, we're interested in dividends for our models. So notice they say over the last 10 years, it's been 6%. Last 5 years, 5.5%. We believe going forward, that's Johnson Value Line believes, their analysts believe over the next 5 years they're going to be increasing the dividend 6.5%. So we're going to use that number. And then this is a must read, folks. You've got to read this report. I mean, read everything you can about the potential companies. But Value Line, they've been around a long time and they've done a good. I'm not, I don't have any shares in Value Line. I'm not getting any kickback. There are others. For many years, Standard & Poor's had a same idea, these single sheets. I didn't think they were very good. I haven't seen them in years. Standard & Poor's spun that off. Now it's another company called CRMA or something. I'm not sure. I haven't used them. I really should. I'm just so happy with Value Line. I really should. And then Morningstar wants to get in their cookie jar too. Morningstar started off as a company that researched mutual funds, and now they do stocks. And some of the students tell me, "Oh yeah, and TD Ameritrade and Schwab have their own research sheets like this, research information." So there's plenty of information out there. You don't have to use the Value Line. But for our class, we hope you do. And then you decide if you like one of the others. Because again, libraries are cool, dear students. So remember, we're going to take, there's the timeliness. There's the timeliness. They're pretty positive on Johnson & Johnson, but they're not giving it its #1 rating, which is meaning, hey, we think in the next 6 to 18 months, this is a stock to be in. But I really like this safety with 1. They mean, no, Johnson & Johnson is not going out of business anytime soon. And we'll talk about technical analysis later on. They have their own little proprietary. They don't tell you how they do it, and they keep mum. But they have their own little technical indicator that they say, oh yeah, it's a good idea to buy this stock from the technical analysis point of view, which we'll discuss later on, which is, in my humble opinion, borscht. But what is this little guy right here? This says there was a very brief recession in 2020 because of COVID. Anytime there's a highlighted area, that's a recession. And here's the price. It's bouncing around. And they think by 2026, 2027, 2028, we'll use that data. It'll be between $225 and $275. So let's continue and discuss the sip from the financial fire hose. Interspersed among the mountain of data, did you notice the highlighted historical dividends, the future stock price predictions, and the predicted growth rate, dividend growth rate? Well, I pointed them out for you. There are other models that we talked about that use sales, earnings, cash flow, profit margins. Did you read the company analysis? I hope you do. Personally, your humble instructor does not make any decisions about individual stocks without consulting the value line. Now, the models that we've created, you can use a 99-cent calculator to do. But we hope that you play with the spreadsheets for the discounted cash flow model. And, um, and this is a spreadsheet now that we've created just to highlight some of the data that you get from Value Line that you can use to quickly calculate the Gordon growth model and the discounted cash flow model. So here again it's on the website. Play with it. Don't worry about. There's this presentation on how to use the spreadsheet and make a copy of it and the like. It's just like a big bingo game. But here we put anything that's highlighted on slide 42. We put the data in, and we got the data. Remember the highlighted dividends per share for the last 7 years? We put that in. We also put the current price, and I got that from Yahoo. And then the predicted price. Now, what I did, I probably should have used 225, but I used the midpoint. Remember, Value Line said 225, between 225 and 275. So I just used 250. This is judgment, folks. Remember, we're just predicting the weather, only worse. So I put 250. I'm using their predicted dividend growth rate of 6.5%. But given the dividends of the last 7 years, including to 2023, we calculate the average dividend growth rate of 6%. So they're very close to one another. We're going to wind up getting very similar results, 6.5%, 6%. But here is the Gordon growth model at 12, 10, and 8%. Now, if the dividend growth rate were greater than 8 or 10 or 12%, we would wind up with not applicable. It would the model would say, I can't do this. You got to give me a growth rate that is less than the required rate of return. So we used 10, 12, and 8%. And notice at 12%, the price is $91. At 6.5%, which is what Value Line thought, and $83, what we calculated the last 7 years. At 10%, it's $125, $143, which is getting close to the current price of $160. But if we simply say, you know what, we're happy with 8%, then it says, oh yeah, Johnson & Johnson is a very good deal. Again, it's just pointing us to a company like Johnson & Johnson. And it says, if you're just happy with 8%, oh yeah, this is worth a whole lot more than $160. In the shaded areas, now let's read together. We enter the historical dividends per share, the current price, and the predicted price in 3, 4, or 5 years, and the Value Line's predicted dividend growth rate. The spreadsheet does the rest, you see? And we're just looking at the first part where they calculated the Gordon growth models. Notice that just changing your required rate of return, your discount rate, changes the prediction results drastically. For our calculated growth rate from $83 to $150, and for the predicted growth rate from the Value Line from $91 to $334. So now let's take a look at another part of the spreadsheet. This part's the same as it was in the previous. It's where we put the data in. But this part is calculating using the discounted cash flow at model at 10% and again at 8%. For the our average dividend growth rate, which is what we calculated here, and for the Value Line's predicted dividend growth rate. And you'll notice that the results are almost exactly the same because 6.5% and 6% are just pretty close to one another. So what did the spreadsheet do? It calculated what it thought the dividends for the next 4 years would be, 2023, 2024, 2025, and 2026, and then used the expected stock price of $250. Remember, we split the difference Value line said between 225 and 275. So we're trying 250. Now you could just put in 225 and you'll get different numbers, right? And so notice that they're almost exactly the same. And both the models in both cases are saying that, this is potentially a very good deal for us. We think it could, if we go with the 10% model, it's saying it's worth about $187. If we go with the 8% discounted rate, it's saying it's worth over $200. Pretty amazing. Notice that they yield very similar results because they're very close to one another, 6% and 6.5%. And then the last part of the spreadsheet does the internal rate of return. And it's saying, and we do it both for our average growth rate of the dividends, which we've calculated the last 7 years, and the predicted growth rate, which is what Value Line predicts. And because they're very close to one another, 6 and 6.5%, you notice that the two internal rates of return are very, very low. So the spreadsheet, the internal rate of return calculation is saying, look, if you get these dividends over the next 4 years, and the stock price indeed is 250, and we probably should use 225. I'm thinking now that was a mistake. I should, this is judgment. Your judgment starts to come in, and Benjamin Graham, a million years ago, said any system that removes human judgment is bound to fail. We need to, and it just takes practice, right? It takes practice, and you're going to make mistakes. But if you stick with companies like this, those mistakes won't be really, really costly. So the internal rate of return calculations using both the average dividend growth rate and the Value Line's predicted dividend growth rate, again, give us similar results. Now that we've done all these calculations, let's ask ourselves, would you consider owning Johnson & Johnson, right? Now we got to look at their competitors and the industry as a whole, but have you ever used Q-tips or Band-Aids or Tylenol or Johnson's baby shampoo or powder? Yeah. And also they do a lot. They're a big company, folks. They've been around for over 100 years. And you may have gotten their COVID-19 vaccine. It's a single one where the other two, the Moderna and the Pfizer, BioNTech, how do you say it? I don't know how to say it, but it's through Pfizer. Those were 2 shots. You got to take 2 shots. The Johnson & Johnson was just a 1-shot vaccine. But of course, get your boosters, folks. I've gotten mine. So what do you think? Is this cool or what? Huh? I think so. It's what I do, and sometimes it works great and other times it doesn't work, and that's part of investing. But by pointing us towards companies like Johnson & Johnson, like Caterpillar, like Illinois Tool Works and Target, we're not going to explode on the upside. But at the same time, right, as one of my, I think it's in this presentation coming up, but one of my brilliant clients, this guy's really sharp. He said, look, I told him about how my philosophy, what I like to win. I didn't use the word win, but I like to slow and steady, long-term oriented. He goes, look, I don't have to win big. I just have to win. I love that quote. I use it over and over again. So I'll probably hear it again in a few minutes. Ay, payano, do we have to use the spreadsheet? It's so confusing. Well, look, no, you don't. We promised you that you could perform all the calculations in this course with a 99-cent calculator. And we've kept that promise. Everything we did on the last spreadsheet, all those calculations, and we did in the previous 2 presentations, can be done manually. But it's tedious. Wouldn't you rather bang it away at the spreadsheet until you figure out how to use it? Look, it's just a big bingo calculator. B3 plus N15 minus G11, whatever. It ain't that hard once you've done it and, make your mistakes and figure out, oh yeah, this is what I'm supposed to be doing. The real prize here, as far as I'm concerned, is that all we need to do is consult the value line for the data to use in our spreadsheets or our manual calculations. Now we have to add our judgment, and be more conservative depending on our temperament, or more aggressive. But still, this gives us a solid foundation from which to start with. And we're not just listening to some person on the internet or the television tell us that yeah, Johnson & Johnson is a good buy or bad buy. We're backing it up with real data, with, as Sir Arthur Conan Doyle says, it is a capital mistake to make decisions without data. So, are you excited? I hope so. Are you ready? I hope so. Good, because it's your turn. It's time for you to fly solo. Find a library near you that has the value line, or hopefully in a week or two, who knows when it's going to happen, we will give you a code for you to go to the Southwestern Community College Library and get the value line online in the comfort of your own little home, on your telephone, or on your, I think it's easier on a computer, but hey. Before you go, though, think of a few companies that you would like to research. Maybe downloading their annual reports from their websites beforehand. Okay, so you hear what they say about themselves, and of course they're going to do their best. Remember the earnings call we asked you to do in Chapter 3. They're going to do their best to put their best foot forward. And sometimes you read between the lines, and they say, things are not so good this year. Ask the reference librarian at the library for the value line. Find the index of companies in alphabetical order, and then they point you to the index. Will tell you which packet you need to seek, which company you're seeking. There are thousands, folks, there are thousands of companies. And what is cool about the value line is they group the competitors close to one another. So if you find Coca-Cola right next, there'll be Schweppes and whatever that company is that owns Schweppes, I forget. And then and Pepsi and Monster, they'll all be right next to one another, which is very good, right? That's what we want. We want to look at the competitors. And I know this is going to maybe not sound right, but I want you to get lost in a nice way. Have fun. You may think I'm crazy or maybe boring, but one of my favorite things to do is trundle on down to our library, because we're really lucky. It's a local library that right by us that has the value line packets. And my wife is a voracious reader of historical novels. She just goes through these things like water. And so she goes off and finds 5 or 6 novels, and I go to the value line and got my laptop. I start plugging in the numbers and looking up companies, and that's a great afternoon for the two of us. Well, I hope you find the same joy and interest that I do with researching companies. And if you do, great. And if you don't, that's great too. Maybe you need mutual funds, right? Maybe you need somebody to a financial advisor. That's neither is right or wrong. They're just different. Because what I find is that if people enjoy doing this, if they enjoy doing the research, they usually do pick some pretty darn good stocks. And of course, we're going to make mistakes. It's inevitable. But if we stick mostly with these stalwarts, as Peter Lynch calls them, with their roots deep in the economy, throwing off cash, we should do okay. Unless the world ends. I get a kick when some speculators trash the value line. They make mistakes too, just like everybody else. But I would sure love to see how those traders' long-term results stack up against the long-term results of the value line. Who do you think would have the better results? Oh, by the way, when you go to the library and look at the value line, in the index packet, they have model portfolios for you. Sample portfolios that you can use. This one's for aggressive investor. This one's for a conservative investor. It's actually very cool. I don't always agree with them, but and they have one for income-oriented investors. It's actually it's a great resource. It's been around for decades. Yeah. Okay. Continue. The bottom line. Okay. Woo. Okay. Dear investment gurus, from now on, you will have your eyes wide open when you look at a potential company. What is it in terms of its dividends, what's it worth in terms of its dividends, what's it worth in terms of its potential capital appreciation. But once we have finished all our valuation calculations, what should we do? Should we really place much value in our predictions? The answer is emphatically no, 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 no. Rather, this is what I like to think of. Maybe I'll do it someday. I don't know. We should hurl them into the vast ocean along with the ashes of our dead pets and relatives, or shred them into millions of little pieces of paper and use them as confetti at our next party, or burn them in a huge bonfire as we dance naked under the full moon. Or all three. Look, we do these calculations to simply tilt the odds in our favor, instead of placing any significance in our predictions. After we've finished, we simply ignore them. We ask ourselves a very simple question. Would we want to own this company? Do we believe this company will succeed? What is their potential? What are their products? What does the future bring for them? And of course, those answers are very difficult to come up with because we don't know the future. Peter Lynch, in his book, One Up on Wall Street, which you're going to read, right? Please read it. It's one of the best books, first books to read. I could read the textbook for the class, but it's one of the best textbooks, books to read for a first-time investor. One Up on Wall Street, okay, but read the One Up on Wall Street and A Random Walk Down Wall Street also, but One Up on Wall Street. This is before the internet, right? This is and microcomputers were just making their way into the office in the 1970s and 80s. He would put all his calculations and all his newspaper clippings and everything he could find from the library into a 3-ring binder about FedEx or Nike or whatever company he was looking at. He was a big fan of, what was the company? Dunkin' Donuts. He made a lot of money off of Dunkin' Donuts. And he would put them in a 3-ring binder. And then after he had done all his analysis, he would hold the 3-ring binder up in front of him and give himself a 60-second, 90-second story. This is Nike. I want to buy Nike because it is the premier shoe, whatever you call them, tennis shoes or whatever, athletic company in the world. They are making their competitors look bad, whatever. He'd give himself a little pep talk. And after he did that, he would have usually said, yeah, I want to buy it. Or no, maybe I'm selling this company because of this, and the other thing. He says, watch the story. Give yourself the story. I think that's very cool, right? I think that's very cool. And then Warren Buffett says, look, if you could buy the entire company, if you could buy FedEx or Nike or whatever, you had the cash to do it. Of course, none of us do. And you would want to own that company as if it were a shoe store or a pizza shop or whatever. Then go ahead and buy 10 shares, okay? Because you are, in a real sense, part owner of the company. Does this make sense to you? I think it does. You want to be an owner of a company, not a renter that owns the stock for 3 weeks or 2 weeks or 3 months or whatever. You want to own the company for the long term and share in their success and the cash that they throw off. We will leave the last quote to one of the best writers of a book called Margin of Safety. It's out of print, and it's actually become very, very valuable. These things are selling for a couple $100 because Mr. Seth Klarman, I'm not sure how to say his last name, but it's a great book. Read it. But it's old. It's from 1990 or something like that. But it's not that old. I mean, One Up on Wall Street's from the late 80s, and Random Walk Down Wall Street. But he's updated that. Random Walk Down Wall Street, he's updated it. But Mr. Klayman does not want to reissue Margin of Safety, which is kind of sad. Somebody made a copy and started sending it out, and they sued them, right? Well, of course, it's copyright. It's still copyrighted, but you can't get it. So it's a great book. So we'll leave We'll leave him to have the last word because I really love what he wrote here. The problem is that it is easy to confuse the capability to make precise forecasts with the ability to make accurate ones. Any attempt to value businesses with precision will yield values that are precisely inaccurate. You see, all our predictions have been very precise. We got the calculator, got 6 digits, but that's our enemy. We know beforehand that as we make these calculations, there's a 99.999% chance that they will be inaccurate. It's very rare that you actually hit it right on the money. So why do we do it? Why do we perform them? Look, these calculations help us identify companies that are prudent, long-term oriented investments. They won't make us wealthy quickly, but they should make us wealthy unless the world ends. To quote I already told you this quote, but I just love it. I'll tell you it again. I don't have to win big. I just have to win. So, when you're at that party and somebody is talking about they bought whatever company, Amazon at $5 and now it's $5,000 or whatever, growth-oriented investors, they don't tell you about the time they bought a company for $5 and then it's turned out to be 50 cents. You can just nod your head and say, yeah, I got real boring companies like Johnson & Johnson and FedEx and realize that, they might do very, very well. And we wish them luck. We don't want growth-oriented and aggressive growth and speculative-oriented investors to do badly. We don't. But we know that they are taking on a whole lot of risk. And it ain't fun to lose money. You're going to lose money sometimes, but you're not going to lose as much money if you buy Pretzels Unlimited than if you buy Jeans R Us. Slide 49. Dear students, oh my goodness, we are so proud of you. Think of what you have learned. Now, what did we say? Go back over, do these problems over and over and over again until you see them in your sleep, until you're dreaming them. Because as I hope you've seen, the calculations are actually very easy once you do them a few times. The understanding of the concepts is a little tricky. I'm discounting a future cash flow to create the present value. Yes, that's exactly what you're doing. That's the verbs we use. That's the words we use. And I know it's a real pain in the neck, but it's what we do. We take those future cash flows, we bring them back to the present, and we are now official investment gurus. You have a weighty responsibility now. You are going to be the investment guru for your friends and family and your colleagues, and you can't let them down. No, 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 no. Now, our next chapter will be another chapter on fundamental analysis where we will learn to sift through financial statements, income statement, balance sheet, and the cash flow statement, and create ratios and do what's called ratio analysis. Now, you accounting majors, relax. We're not going to create any financial statements. No journal entries, no trial balances. Don't worry. We just grab them off the Infernal Net or off the company's website, and we use them. Thank you, accountants. See you in our next chapter on fundamental analysis, financial statements, and ratio analysis. Dear students, we are so proud of you, official investment gurus.